Hello. Today, we'll continue our discussion on the fascinating world of volatility models. As you might remember, our previous session focused on the EGARCH model. For today's session, we will be discussing the EGARCH model, and as is our custom, we'll apply the principles of finance research to our work.
Alright, let's take a moment to fully understand the underlying theory. Just to refresh our memory, the EGARCH model is represented by this particular equation in which the variable h specifically denotes the variance of the observed residuals.
W, which is also commonly known as omega, represents the fundamental baseline volatility.
So this initial component that we're looking at right here, this is the lag squared error shock. And then following that, we also observe the lagged variance term. This particular setup, as you might recall, is what we refer to as the EGARCH model. Now, considering that the left-hand side of our equation specifically represents variance, it became absolutely necessary for us to impose a specific restriction. For example, the omega must be greater than 0, and this other term must also be positive, and that one too, just to ensure that every time we solve this equation, we obtain a value greater than 0 because we cannot have a negative variance.
That should always be a positive thing.
It's important to note that the EGARCH model might not possess the capability to accurately quantify the differential impact of unexpected shocks. The reason is that when we use a square term, it inherently treats both positive and negative values symmetrically. Therefore, we cannot determine if, for instance, a negative shock has a greater or lesser impact compared to a positive shock. The EGARCH model, which is called the exponential EGARCH, is designed to address this asymmetry.
We are confident that we will successfully resolve this particular issue. Now let's shift our attention and carefully examine the precise format, understanding the structure and how it's laid out. Following that, we'll delve into the intricacies of the functional equation, exploring its properties and implications. First, the EGARCH model, notably, does not impose any inherent restrictions on its parameters. Indeed, these parameters are perfectly capable of taking on negative values. Consequently, the entire resulting expression itself can also be negative, and this is fundamentally due to the fact that we are modeling the logarithm of the variance. We're not talking about the variance itself, but rather its logarithm. So even if this value turns out negative, and indeed most of the values we're dealing with here will likely tend to be negative, the overall final result being negative is completely acceptable and perfectly fine, because what we are truly working with is the logarithm of the variance, not the variance itself. And whether this particular value happens to be negative or perhaps even positive, it truly makes no difference because the resulting edge will consistently remain positive. The reason is, if you want to solve for the edge after you've found the EGARCH left-hand side variable, which is the logarithm of variance, if you want to find the variance itself, you simply need to exponentiate. You need to calculate the exponential function of the resulting logarithm value. So you raise that to the power of, you'll be using the mathematical constant e, which is also known as the Euler number. By the way, for your information, the mathematical constant e has an approximate value, 2.71828. It's most commonly known as the Euler number, honoring the renowned Swiss mathematician. The tangent number. So if you take that specific number, the Euler number, and you raise it to the power of the output from the EGARCH model, regardless of the sign, even if that output is negative, the final result will always be positive. You can perform that mathematical calculation if, for example, if this is negative, it will become e raised to the power of the natural logarithm of the variance. And that specific numerical value will be less than 1, but it will certainly be, when we consider the final outcome, definitely greater than 0. The other advantage of the EGARCH model is that we allow for the asymmetric. We're looking at the effect of the error shock, a significant factor that is primarily captured and represented by the last term in this expression. So to ensure clarity, let me just start right from the very beginning. Here, this symbol represents omega, and this particular value here denotes the baseline volatility. So even if all these factors are at 0, we still observe a fundamental level of baseline variance. This inherent variance is what we refer to as lagged variance, and this lagged variance will inevitably have a significant impact on the current variance because volatility inherently persists. And typically, the beta coefficient in this particular analysis is greater than 0 to indicate that the volatility persists over time. This particular term, which we are introducing now, is designed to precisely quantify the magnitude of the error shock, and its characteristics in many ways might appear quite similar to what we observe in the established ARCH component, specifically this particular one we've been discussing. However, there's a crucial distinction. Unlike the ARCH model, we will no longer be squaring the value of this error shock. Following the same principle we discussed regarding the arch, our primary focus is on understanding the true magnitude of any error. We achieve this by carefully standardizing the error shock, dividing it by its corresponding standard deviation. The square root of h in this instance is the square root of the variance, which we know as the standard deviation. So, in this instance, we are determining the standardized score, which reveals the extent to which the error shock from the previous period, specifically t-1, is greater than the established standard deviation.
So, what we're looking at here is essentially how many times the error shock is greater than the standard deviation. This value, this ratio, can either be a positive number or conversely, it could be a negative one. For instance, the final answer might turn out to be 2 or perhaps even -2.
At the end, we take the absolute value of the final result so that it will always turn out to be positive. This is because our focus here is solely on the magnitude of the number rather than on the sign. Subsequently, we proceed to compare this particular observation with the projected z-score tracking its progression across the given timeline. Consequently, during this specific period, we are examining the z-score, which quantifies the relative error shock value in proportion to the standard deviation. We then proceed to compare this particular value to the average of z, taken over a specific period of time, a quantity which is formally referred to as the expected absolute value of z. If this measurement is, for example, considerably larger, it suggests that we are dealing with a rather substantial error shock. If this is less, it means that we'll experience a shock that is considerably smaller than what we would typically expect on average.
So this specific method will adequately account for the overall scale and the precise magnitude of the potential error term. The last part we're discussing is the asymmetric component, also known as the leverage component. Here, our focus is specifically on the sign of the error shock. This is precisely why we do not use the absolute value sign. Therefore, the sign itself truly matters. Whether it happens to be positive or negative, we always retain that specific sign. And we also need to take into account the relative magnitude of the error, particularly how it measures up against the standard deviation. So for instance, if the error is significantly larger than the standard deviation, its impact would become much more pronounced. However, it's important to note that we always retain the original sign of that error.
So, if we were to consider something positive, for example, it's quite possible that an error shock has a reduced impact on the logarithm of variance when compared to a negative sign. This finding has been well established and clearly demonstrated in the financial literature, particularly where a bad, unusual, extreme events or shocks, such as an exceptionally poor or negative investment return, especially during periods of severe financial crisis, will inevitably lead to a much higher degree of variance
pertaining to the return.
So the minus sign here will most likely correspond to a significantly higher increase in the logarithm of the variance than the positive one. So generally speaking, the indicator we're observing here, though not always the case, but more often than not within the financial sector, tends to be a negative one. This is primarily due to the impact of adverse economic shocks. It is more detrimental to the overall variance, meaning that negative shocks will typically cause a greater increase in the variance compared to positive shocks. All right, so what we're looking at here, the specific model is indeed the EGARCH, and again, the parameter omega, the very first one that you see, it represents the fundamental baseline level of volatility. Now, the beta coefficient, which is presented right here, serves to measure the extent of volatility persistence, indicating how strongly past volatility values.
The level of volatility experienced in the past often serves as a reliable indicator for future market instability.
So when we see larger values for the parameter B, it means that volatility shocks will tend to decay quite slowly. Consequently, this indicates that our system possesses a kind of memory, where the observed volatility persists and remains significant over an extended period of time. The alpha parameter in this specific context measures how strongly the volatility itself reacts or responds to new information. The system's response is directly influenced by the scale of the shocks, particularly when considering their relation to the usual or expected magnitude. Consequently, if a shock occurring within a specific time frame proves to be significantly larger than the average shocks observed, then its resulting value will undoubtedly become higher. So in the event that the shock is significantly larger than its typical magnitude, this particular term will then become positive. And conversely, if the shock is considerably smaller than what is normally expected, then this specific term will be negative. Typically, the sign here is positive because greater shocks, quite intuitively, will naturally lead to a higher degree of volatility. The final term, as we've already mentioned before, the leverage effect, clearly shows the imbalance between positive and negative movements. Consequently, if the coefficient that's attached to this final term, when this value is negative, it indicates that negative shocks cause a much greater increase in volatility than positive shocks. The system operates effectively because if this particular value is negative, and for clarification, it should be understood that the variable z in this context is equivalent to the standardized error, which is expressed relative to the standard deviation of the associated error term. So this particular value here is z. Now, if the error term happens to be a negative value and the coefficient itself is also negative, a negative number multiplied by another negative number, that product will ultimately become positive, and this in turn will increase the logarithm of the variance.
However, if we observe that the sign of the leverage term is indeed positive, this indicates that any positive shocks or unexpected events will actually lead to an increase in overall market volatility. For instance, if we are provided with these particular values, specifically omega, alpha, beta, and the important leverage term, coefficient, we can then quite simply substitute these numbers into the formula, exactly as illustrated in this example. Let's consider an example. If the error term we observed in the previous period happened to be negative 0.06, we might ask ourselves, is this particular value significant or sizable? To determine its significance, we typically compare this observed error value to the standard deviation. Now, what exactly is the standard deviation? It is, by definition, the square root of the variance of that specific error term. If we take the square root, we will then obtain this particular number. It appears that the error shock is quite sizable, as it's approximately 2 times higher in absolute value than the standard deviation. Therefore, the z-score in this case will be -2. But let's consider the absolute value of our variable z, which is precisely equal to 2. Consequently, we're dealing with 2 critical elements here. The first of these important factors is the concept of leverage. And as we previously established and discussed, it is highly probable that any negative shock will ultimately have a much greater and more pronounced effect on the overall variance. The other important aspect to consider is the magnitude effect, where the absolute value of z is quite substantial, given that it is 2 times greater than the typical standard deviation. So, let's assume the expected z over time is only 0.798. This means the error shock is higher than the average by 1.2. So if you plug these numbers in, we get a sizable magnitude. We also have a sizable magnitude with a negative sign. So multiplying by the leverage coefficient will make it positive.
Furthermore, the magnitude itself is going to increase, meaning we'll observe 2 separate effects. The sheer size of the value, its inherent magnitude, will naturally cause an increase in the overall variance. And furthermore, the critical observation that the recorded error is a negative value, this fundamentally represents a significant loss, which is not just a simple deviation, but rather an undesirable abnormal shift or movement within the variable itself. And this particular type of movement will inevitably result in an even greater, more pronounced variance. And of course, we have the persistence term along with the lagged variance and also the baseline volatility. We then plug all of these numbers in, and that allows us to find the final answer. Are we looking at the negative variance here? The answer to that question is actually no. What we have here is the negative logarithm of the variance. To determine the variance value itself, we simply need to take the exponential function e raised to the power of that number, and that will then give us 0.00272. This figure represents the variance. If you take the square root of that value, it will give us 5.2%. This represents the standard deviation, which is predicted or modeled by the EGARCH process. Therefore, you might refer to it as the expected volatility or simply the standard deviation, or more precisely the conditional standard deviation. So, how exactly can we determine the long-term, the long-run volatility of this particular system? To do that, we simply need to apply this specific equation. We then take the value of omega. First, we establish the baseline. Then, we specifically examine the beta, which is defined as the particular term or the numerical coefficient that is directly attached to the lagged variance. And this, of course, represents the EGARCH component. Should we substitute these particular numbers into the formula, it will then reveal to us the long-term standard deviation. Therefore, the EGARCH model can precisely determine the exact value you require for the standard deviation. This means you can then utilize this model to effectively forecast the standard deviation for every period. In order to find the long-run standard deviation using the EGARCH model, you'll start by identifying the omega value. Then you'll take the beta coefficient, you'll substitute these into the appropriate equation, carefully plugging in all the required numbers. This will allow you to calculate the long-run standard deviation. Let's proceed to apply this now by using the Finance Research Gateway. I'll now proceed to select the time series data set for our analysis. Our chosen time period will commence in the year 2000 and it will conclude in 2024. With these settings confirmed, we'll then proceed to apply the filters. This brings us to the crucial next step in our analysis. Our primary objective for this stage is to define and then create a specific variable of interest, which in this context will represent the overall market return. More precisely, the key metric variable we're focusing on for our calculations is the monthly return. Consequently, our task is to accurately search for and retrieve the relevant stock monthly return data. So, how exactly can we transition from the individual stock or firm level monthly return to the overall aggregated market return? We begin by selecting the main variable, the fundamental base variable right here. However, after that, we must carefully choose the specific sample group for which we wish to determine this particular variable. This information can be specifically determined for a single individual firm, should you require that, or it could be applied to an entire industry, or perhaps even across a broader economic sector, or ultimately for the entire market. So let's proceed and apply it to the whole firm. Now, if you're looking to apply this particular approach or metric to more than just a single firm, you'll definitely need to specify your chosen aggregation method. So the question then becomes, how exactly do you intend to derive a single representative number that encompasses all these different firms for each given month? Are you planning to calculate the simple average, perhaps the total sum, or maybe even the median value? We're going to focus on the median value. So our methodology will involve calculating the median stock's monthly return for every single firm across the entire population of firms for each and every month. So let's consider having 4,000 distinct firms that we observe each and every month. We then proceed to calculate the median value from all of those 4,000 individual observations. This entire process will ultimately provide us with a single representative numerical value, and that particular number will then clearly indicate the overall market's return. To select the entire market, you just need to leave these filter fields completely empty. By default, the system will then automatically include the whole market. After that, you can simply click apply.
So as you can clearly see here, we have all the firms that have applied. Now you might be wondering, how exactly do we manage to derive a single representative number for each and every month? Well, what we do is we aggregate this data by carefully taking the median value across all of these individual firms for every single month. And for simplicity, let's go ahead and refer to this as the market variable.
You need to return. Then we perform a click outside the box to ensure the effect is applied.
All right, we're completely ready. So we'll scroll down and try to search for what we're hoping to find.
We'll be discussing the EGARCH function. But before we do that, let's take a moment to examine the chart presented here. This particular graph illustrates the market's return performance across a specific period. Our primary objective is to accurately model and understand the inherent volatility within the error term.
Now, since the monthly market return is close to zero, you can therefore easily visualize how these sudden, sharp movements, whether they're increasing or decreasing the values, are essentially reflecting the inherent volatility present within the error term of our model.
So that is like a significant positive error shock. This indicates a very favorable and unexpected outcome.
My apologies. What we're observing here is a rather significant negative error shock, and you can clearly observe that the fluctuation around the average value, which represents the error's inherent variability, is quite substantial.
Can we accurately model that or perhaps predict its future behavior? This is precisely what we aim to achieve using the EGARCH model.
Now, if you take a moment to observe here, for instance, during the time of the financial crisis, in that specific period, we experienced quite significant market volatility. So it seems to be the case that during times of crisis, firms generally tend to experience abnormally negative returns, and consequently, these negative error shocks centered around the mean are subsequently followed by a period of significantly greater volatility. We can draw the very same conclusion from what we observed throughout the recent COVID-19 crisis, a time when market volatility experienced significant spikes and increased far more dramatically than during any other comparable periods.
That strongly suggests using the EGARCH model, as we must account for the asymmetric or leverage component, where a negative error will have a greater impact on volatility than a positive error.
As you scroll down to the designated section focusing on volatility and financial time series analysis, we then proceed to carefully select our primary variable of interest, which in this particular case will be the market return itself. And then from this menu, we will select the EGARCH model.
Now we have the P, the Q, the leverage. Let's increase that to 1. Since the EGARCH model isn't directly related to the EGARCH framework, we'll simply remove it from our consideration. Now, what exactly does this P represent here? The arch lag parameter will directly correspond to this specific coefficient. This is precisely what we refer to as the arch term within the EGARCH concept.
It's quite possible that the naming convention we're using here is primarily relevant to the EGARCH model. However, it's absolutely imperative that we consistently apply these U-uniform boxes to every single family within this framework.
So, when we mention P in this instance and we're making the selection of the EGARCH model, that will be represented by this specific component.
The arch component you see is primarily concerned with the magnitude of the error shock, how large or small it is. In the EGARCH model, we typically take the square of these error terms. However, in this specific case, we utilize the absolute value instead, but the underlying concept remains quite similar. Therefore, this approach effectively captures the essence of the arch component within the broader EGARCH family of models. The EGARCH component is the lagged volatility, and that's what you see here. So first, we're identifying the EGARCH component, then we move on to the arch component, and finally we observe the leverage lags. This particular section here illustrates that. It specifically refers to the leverage effect, which is essentially known as the asymmetric effect. So the system or the specific application is currently prompting us to precisely determine the exact quantity of lags that should be assigned to each individual instance. In this particular demonstration, we observed that there was just a single lag, but naturally we possess the capability to significantly extend that to have... We're considering more than just one lag here. For example, we might be looking at 2 lags or perhaps even 3 or potentially even more than that. Following the same logic, we can extend this concept to a lag of 2. So we would express it as z minus 2, then subtract the expected value of z.
And here we can extend that to other things using 2 separate lags of z rather than just a single one. So the first point means you'll be using the exact same equation as this one. For the second, you'll need to add an additional term for each individual component. And instead of having just a single lag, you will then have 2 distinct lags.
So, for the purpose of our analysis, let's proceed with just a single lag. Considering the innovation distribution, what precisely will be the resulting distribution of the z-value? In most situations, it's usually normally distributed. The standard Gaussian normal distribution is quite sufficient, but if you feel that the z-value demonstrates a fatter tail or a greater degree of skewness, then you have the flexibility to make necessary adjustments. For now, let's proceed with the standard normal distribution. So what this means is that if you take the z-value, which represents the standardized shocks, and then you proceed to draw a complete distribution, for it to be something that's quite close to what we would consider a normal distribution, where we observe a clear symmetry that exists between the positive and the negative values. And, for example, we would also expect to observe what are known as very thin tails. And then, following all of that, we would proceed to fit the volatility model. So, here we are, presented with what we call the mean model. Now, a crucial question arises. How exactly do we go about estimating the associated error term within this model? Well, the estimation of this error term is, in fact, performed directly by utilizing the very same mean model we just discussed. We are using the mean model. So this right here is the mean equation. The monthly market return, as you can see, is a direct function of its average, and then the difference between each month's return from that specific average value that will ultimately give you the error term. This is the process by which we obtain the error term. Once we have successfully determined this error, we then proceed to implement the EGARCH model. Within this model, we specifically identify the key parameters: omega, alpha, gamma, and beta. This represents the typical or mean value that the market has yielded as a return across an extended period.
Now, these specific points are directly connected to the EGARCH approach for modeling the error term, and this error term, to reiterate, represents the precise difference between the observed monthly return and its corresponding average monthly return.
The error component is modeled, and we already have the coefficients. The coefficients are omega 1 minus 0.6, the alpha, which is this part,
0.27. For the leverage component, we've determined its value to be minus 0.45, and then considering beta, which is specifically the lagged variance coefficient, that number stands at 0.74.
So the baseline volatility that we're looking at is this particular value. Does that imply that the volatility itself will be negative, even in a scenario where all of these coefficients are set to 0? The straightforward answer to that question is absolutely no, because what a minus sign in this context truly signifies is that the logarithm of the variance is negative.
So the variance will still be positive.
Now notice here, as expected, the leverage effect is negative, meaning that negative shocks will have a greater, more positive impact on the variance. Additionally, as we had anticipated, the lagged variance continues to persist and its coefficient is indeed positive, yet it remains below 1.
So what we're seeing is that its influence will naturally diminish and eventually fade away completely as time progresses. This means that even with just a single time lag, we're still going to observe a substantial effect stemming from the previous period's volatility, quantified at 0.74.
The magnitude of these shocks, as we had expected, is positive. If you encounter shocks of a much higher magnitude in an absolute sense, because we are specifically taking the absolute value into account here, if the absolute value of that particular shock is greater than the average, then this will inevitably lead to a significant increase.
The logarithm of variance, and eventually the variance, because the coefficient here is positive. The long-run volatility, as it's calculated and supplied by this particular equation, if we were to carefully plug in the values for both omega and beta, specifically these two components. When we apply this to the mathematical equation, we then obtain the long-term volatility, which is precisely 4.05.
So the EGARCH model predicts that on an average basis, the inherent volatility of the error term, which encompasses the shocks and the overall movement observed within the monthly market return, is approximately 4.05. This represents the monthly market volatility, and that is quite significant. We're not discussing the annual figures, but rather the monthly data. So that concludes our session for today. Thank you all very much for tuning in and listening.